The other aspect to considering stocks' long-term moves is whether you're looking at an arithmetic chart or a logarithmic chart. Because if you look at stocks on an arithmetic scale, you can really get freaked out. Because what happens is a constant rate of appreciation on an arithmetic scale starts going parabolic, as they say. You want to get scared by a trend, look at this thing. And we're all looking at this line and saying, wait a second, this is Cape Canaveral. This can't last. But remember that that's the arithmetic of compounding. And so what I saw in this chart is, yes, in January, it looked like we were getting a little ahead of ourselves. And now we have corrected right back down to this level. The point here is, look, stocks have, over the long term, appreciated at approximately somewhere between 9 and 10%. This chart starts in 1991. Here I'm referring to Jeremy Siegel, Professor Jeremy Siegel, who wrote the seminal book, Stocks for the Long Run, in 1994. This chart starts in 1991. Jeremy Siegel, Wharton professor's contribution to financial academia was, you can take this trend back to 1926 or 1871, and based on a little bit sketchier data, you can go all the way back to 1800, the founding of the Republic, and you found that stocks approximately have delivered somewhere between 9 and 10% over the long term. So what I'm suggesting here is, even though this can look awfully scary, it's just the nature of an arithmetic compounding of returns. And we are right on that long-term trend rate of appreciation that we've seen historically, particularly after this 10% correction. Everybody see it? Now the question I'd have in my mind is, okay, if you're saying, well, over 200 years of U.S. financial history, this is what investors in stocks have, by the way, it's not without volatility. I'm not saying it's just a one-way ticket, but in the long term, there is an underlying engine of wealth formation that's behind this. What is that? This is basically the fundamental analysis of what's going on. Why do we invest in stocks to begin with? So what drives 9 to 10% total return in stocks over 200 years? What is driving that? What do you think? Not a rhetorical question. Who knows? What drives this black line? The S&P 500 price index. Earnings, corporate earnings, period, end of story. We have GDP growth, which drives corporate sales, which drive corporate earnings, which drive stock prices. And earnings over the long term have grown at approximately 7.4%. Wow. When I did this calculation and I plotted a growth trajectory, I superimposed a growth trajectory on top of S&P 500 earnings, lo and behold, I came up with exactly that same growth rate. I really astounded myself when I did the arithmetic. So what we were saying here is that stock prices appreciating about 7.4% long term, add dividends, compounded, you get total return in stocks. But what's driving the 7.4% price appreciation is earnings growth. Now the rest of the story in this chart is indicated in these black boxes. You can see that earnings have appreciated about 7.4% long term, but this year we're expecting a 19% surge in earnings growth. You wonder why stocks are behaving the way they are? What is going on here? What's going on is that synchronized global expansion that John was talking about. The data started getting better. We had this earnings recession in 2015, 2016. Beginning of 2017, the economic data turned up very materially. And 2018, it's exploding to the upside. That's what's behind this move in stock prices. Stocks always anticipate what's coming. Investors have a good way of doping out what's going to happen over the next 6 to 12 months, and that's exactly what's behind the stock market move. But 19% is huge. Again, we're in this period right now of extraordinary surge in earnings, again, compared to the long-term average rate of 7.4%. Almost 3 times the average long-term rate of earnings growth. That's what's behind the stock market move. Making the story even more interesting is this gray box. This gray box was the earnings estimate for 2018 before the tax bill got enacted. The tax bill itself is contributing an incremental 10 percentage points in earnings growth this year compared to what had been the estimate prior to passage of the tax bill. You wonder what got into stocks in the month of January? The tax bill was passed December 22nd. So maybe a little bit too much euphoria, perhaps, but I'm suggesting, but the underlying story here is very powerful. Once again, another look at the same. Earnings drive stock prices, period, end of story. And the reason I emphasize this, so it sounds like a broken record probably to you. Earnings drive stock prices. The reason that's so important to understand is because a lot of people don't know what drives stock prices. You ask the average guy on the street, and he thinks it's like a casino. I mean, a lot of people think that. They just don't know. They say, why would I buy stocks? Aren't they a little bit risky? They do this. It's like, well, it's like a roulette machine or something like that. No, it's not. No, it's a function of a growing, expanding economy. And yes, in the short term, lots of things can whip stock prices higher or lower. But in the long term, earnings drive stock prices. And that's why I wanted to show you this chart. This is earnings, and this is the stock market. You can see the extraordinary positive correlation over time. What I've done here is to apply a PE multiple of 17 or alternatively 19 times earnings. Now the question is, well, if you do that and look forward, where would that put the stock market, say by the end of this year or by the end of next year, assuming that these Wall Street estimates for corporate earnings are anywhere close to being accurate? That's the reason I've done this chart. And lo and behold, it suggests that if the economic expansion stays on track, if earnings estimates are anywhere close to being, then a normal valuation applied to those earnings would put the stock market in this channel here by the end of this year and the next year. Once again, I'm not making a prediction or a forecast for the S&P 500. You know, the economists have been horrible at accurately predicting, especially at key inflection points in both the economy and corporate earnings. But if you take it all at face value today, then the stock market continues to behave very rationally, whereas during January, I would say stocks did get a little bit extended from a valuation standpoint. But today, we're back within this channel of what I consider to be normal valuation. And you could see that, yeah, we could very easily continue to trend higher between now and the end of the year and the end of next year. And it's never going to be in a straight line. And lots of things can come out of left field. I'm just saying there is real fundamental support for stocks continuing to move higher from this point forward.